Thinking through the best course of action for our investment portfolio in the upcoming year becomes crucial as we enter the realm of financial planning. The time is never too early for people with a proactive and long-term investment attitude. Navigating the constantly shifting dynamics of the financial market is the issue, though. Finding the finest ETF and fund investments for 2024 is like trying to solve a complicated jigsaw, especially in light of the recent volatility in market value. Choosing a solid foundation of assets becomes a wise course of action in the face of these uncertainties. A prudent course of action is fine-tuning your asset allocation to match projected future values for the main asset classes. A larger stock allocation in your portfolio may be a way to have high hopes for the U.S. and global economies in 2024. On the other hand, a more cautious approach can cause a portfolio to become more heavily weighted toward bonds. The past 3 months have posed challenges for both stocks and bonds, evidenced by the fluctuations of the Vanguard Total Stock Market Index, VTI, and the Vanguard Total Bond Market Index, BND. Despite recent setbacks, the stock market has shown resilience, with a year-to-date increase of 13.98%. To find out, watch the video till the end and learn how to invest in 2024. But before we begin, please subscribe to our channel, Financial Freedom, and press the bell icon to stay in touch. Major issues over the next year. When you consider how your stock investments performed in 2024, several important questions arise, each with the power to change the financial scene. First off, there are divergent opinions from prominent economists such as Fed Chairman Powell regarding the impending issue of a possible recession, which warrants attention. Another crucial factor is striking a balance, also known as the soft landing, between preventing significant job losses and reducing inflation. Lastly, the unfolding political events in the U.S., particularly the trajectory of Donald Trump's legal proceedings and the upcoming presidential election, add complexity. While the future of these issues remains uncertain, successful investment planning may require adopting positions on each. In personal finance, this is akin to assessing your investment portfolio's performance based on your predictions about the economic landscape, much like how one gauge potential job market shifts when deciding on career investments. Warren Buffett is poised to make a resounding statement on this matter. He's likely to get over $6 billion in dividends next year. Warren Buffett, currently ranked as the 5th wealthiest individual globally, owes a considerable portion of his financial success to a strategic approach known as dividend investing. This method, renowned for its simplicity and accessibility, allows individuals to generate passive income without requiring substantial initial capital. Buffett, through Berkshire Hathaway, tragically holds stocks that yield regular dividends, contributing significantly to his robust income stream. Dividend investing holds appeal for 3 primary reasons. It's a low entry barrier, allowing individuals to commence with minimal capital. It has the potential for substantial wealth accumulation over time. Top dividend earners in Buffett's portfolio. Buffett's fondness for dividend stocks goes beyond personal preference. It reflects his investment expertise. Bank of America Corp stands out among its top dividend earners, set to bring in around $991.5 million in dividends. As a prominent financial institution, BofA has flourished in the current higher interest rate landscape, experiencing a significant rise in its net interest income. In daily life, it's akin to having a reliable source of income, like a well-performing investment or a side hustle, contributing to financial stability. Let's look at the 3 main stocks bringing in this significant income for Buffett. Number 1, Occidental Petroleum Corp. In smart investment moves, Berkshire Hathaway's foresight in 2019 shines brightly, revealing Warren Buffett's talent for lucrative deals. Occidental Petroleum Corp is a prime example of this strategic brilliance. With Berkshire's investment of $10 billion in Occidental preferred stock offering an impressive 8% yield, the estimated earnings stand at a substantial $964.2 million, including dividends. To break it down in simpler terms, consider it like having a financial buddy in a lucrative venture. Imagine putting a significant amount into your friend's business to seal a profitable deal, and in return, your friend guarantees you a fixed percentage of the generated profits. Similarly, investing in preferred stocks involves committing a sum to companies, ensuring a steady income through regular dividends. Number 2, Apple Inc. stands as a prominent figure in Warren Buffett's profit playbook. Renowned for its robust capital returns, Apple contributes significantly to Berkshire Hathaway's dividend earnings, an estimated $878.9 million to be exact. This massive contribution comes from Apple's consistent dividend distributions and proactive stock buyback strategy, solidifying its status as a prime asset in Buffett's portfolio. Understanding the essence of investing in dividend stocks can be likened to planting seeds that yield continuous harvests. Just as consistent watering nurtures a garden, regularly investing in stocks that pay dividends ensures a steady flow of income. Number 3, Coca-Cola. Consider Coca-Cola, a company Warren Buffett staunchly supports with a substantial shareholding. This widely recognized company stands as a beacon of stability, boasting an abundance of surplus cash. The scenario of a company with extra money usually presents 3 choices: retaining it for unforeseen circumstances, reinvesting it in corporate growth, distributing it as dividends to stakeholders. In Coca-Cola's case, its entrenched market position and stability make hoarding excess cash or utilizing it for internal growth seemingly inefficient. Hence, the logical move is to distribute dividends to shareholders, which aligns with Buffett's financial philosophy. Buffett's advocacy for this tactic emphasizes the principle of companies sharing their success directly with shareholders. For investors, it translates into a consistent and passive income stream, a dividend derived from their company ownership. This method mirrors the everyday notion of receiving a share of profits akin to benefiting from a successful venture. It's akin to receiving a portion of the profits of a thriving neighborhood cafe where you hold shares, just like Buffett does with Coca-Cola, turning your ownership into a steady income source. The retail investor's advantage over Buffett. In the wise words of Warren Buffett, the pursuit of earning while sleeping becomes paramount in achieving financial freedom. Buffett's dividend-centric approach, though prosperous, should be navigated with caution by retail investors. While mirroring Berkshire Hathaway's strategy might seem appealing, the uniqueness of individual financial landscapes necessitates a personalized approach. Buffett's historical success, particularly in the 1950s, reveals the challenge. Larger scales limit maneuverability in navigating small-cap opportunities that promise explosive growth. Berkshire Hathaway, valued in the hundreds of billions, encounters hurdles when delving into small-cap ventures. The impact of a modest investment barely registers in its extensive portfolio, while a substantial commitment triggers intricate regulatory complications. In conclusion, following Warren Buffett's investment tips can help you financially. Try different investments based on your situation. Subscribe to our channel, Financial Freedom, click the bell, and email us your money questions. Please share this info with friends to help them too.